Hi, in this video, we'll briefly cover the basic concepts of stocks or equity or shares. So this is probably the most common type of financial instrument that has been traded around the world. So if it's a publicly traded equity, then we can invest it on stock exchanges, for example, the New York Stock Exchange or the London Stock Exchange. So if they're not publicly traded, they become private equity, which is not the focus of this video. Okay, so if I invest in stocks, then I become the stockholder or the shareholder of the firm. That makes me entitled to the claim or a proportionate claim on its future profits, on the profits here. So this is as opposed to having a claim on the physical assets. I do not have a claim on the physical assets. So for example, if I invest in 1% of Nvidia's shares, I do not have the ownership of its physical assets. So I cannot just go into the company and claim 1% of its GPUs or AI data centers as mine. Okay, but rather I have 1% claim on its future profits should the company decides to distribute its profits as dividend. Okay, so with that in mind, let's clarify the stocks into two different types. So there are common stocks and there are preferred stocks. So without any specifications, we'll mostly talk about common stocks here. So with common stocks, there are stocks with voting rights and non-voting rights. And again, the legal side of stuff is not the focus of our video. So if I hold common stocks, then I'm entitled to receive discretionary dividends. So as I said before, whether I receive dividends is completely up to the board of directors decisions. Okay, so they might decide to pay out dividends and to how much of a dividend they should pay out, or not to pay out dividend at all. Right. So second type of stock is the preferred stocks. So they are always non-voting stocks, but they're entitled to receive a fixed payments or fixed dividends. So they kind of act like bonds. Right? So the important thing is that we need to put a price, or we need to value the worth of the stocks. But before we go into the pricing or the valuation of the stocks, we need to distinguish between the book value of the stock or the market value of the stock. So the book value of the stock is basically the net worth of this company and more of an accounting side of the things. So it's basically calculated as the assets minus all the liabilities. So we will see these items on the balance sheet of the firm. So they represent a specific timestamp of this company. So at which specific point of time, how much is this company worth on its book, on its balance sheet, and that's the book value. But the market value is the valuation of its future profits. And whenever we're trading, we pay for its market value, not its book value here. Okay, so this is simply calculated as the number of shares outstanding multiplied by the share price or the market price of the share. So this is something you can see from your stocks app or from the websites or from the quotes from the stock exchanges. So that's the market value. So be very clear about the value we're talking about here. So most of the time we're interested in the market value, and whenever we're doing valuations on the stocks, we are referring to the market value here. Okay, so that's the basics for the stocks or equity or shares. So with that in mind, we can continue to the valuation of the stocks, and I'll see you in the next video.